Okay, hello everyone, guys. Hi, good evening. How are you all? Good evening, everyone. Good evening, guys. Just please comment once about the audio and video of the class. Is everything is working good? Is everything is working fine for all of you? Yes or no? Hi, guys. Hi, Hema. How are you? All good? Everything is clear? Audio, video, everything is clear? Working fine? Okay. So where are everyone? Where are everyone? Why everyone haven't joined the session yet? This is a very important uh for all of you. This is very important class for all of you. I am going to discuss the complete module B theory in two parts, part 1 and part 2, right? So part 1 today and part 2 on Friday, right? So I have to take the session in the morning, but unfortunately I haven't take the session in the morning. So I will be completing part 1 today and part 2 on Friday, right? So Friday actually is all have off of Holi, right? So at 3 p.m. I will be taking the class, okay? After your all Holi occasion. Good evening, Smriti. Good evening. How are you all? Good evening. Hi, Shirish. How are you? And first of all, thank you so much for a wonderful comments, all of you. Thank you so much for such a lovely feedbacks. Thank you so much. Thank you. I have read your feedbacks and it was overwhelming. It was very good. Thank you so much. Thank you, everyone. No off working. Okay. Fridays you're working. You don't have holiday on Friday. 14th March, you don't have holiday of Holi. It is a holiday, right? I think so. I have scheduled the session for 3 p.m. all of you because I think that it will be off on 14th of March. Oh, in South, no holiday. Okay. Then what to do? I think then we have to schedule it at evening, 8 p.m. Okay. So let's start. First of all, okay, okay, no issues. Okay, then I will plan. Okay, don't worry. I will plan. I will take the session at evening, I guess at 7 or 8 p.m. so that you can all attend the session. Don't worry for that. Okay, everyone. Okay, so let's start discussing. See, module B is a very lengthy module. We have approximately 20 units in module B. Plus, you all will be getting the recorded session. So this is not to worry. I just am here to give you a revision of this complete module B. I'm not going to give everything in detail. Why? Because it is not possible in 2 hour or 3 hour or even 4 hour session for completing the whole module D of PPB. First of all, I'm just telling you straight away, frankly, because module B is a very lengthy module. Every unit is actually is 1 hour unit. Okay, so you will get 20 to 25 recorded videos in the app. Okay, you will uh, see that video. You will have the detailed discussion of each and every units. Here just I'm going to give you a short idea, a short explanation from my side that what is in module B, like we have do or like we have done in a IEIFS module C, right? So don't worry if I'm not explaining much in this video. It is not for the full explanation. Kindly understand this because 2025 chapter cannot be finished in 2 hours or 3 hour or even 4 hour video. Okay, and that's why I'm just giving you a very quick revision of each and everything. Detailed video, it is given to you in the recorded format. Okay, everyone, so let's start discussing. Give me 1 minute just. Okay, give me 1 minute. Okay, and then we will start. Okay. So I think let's start, everyone. Audio, video, everything is clear. Rest, yes or no? Everyone. Audio, video, everything is clear. Yes or no? Okay, so let's start discussing this principle of lending, different type of borrowers and types of credit facilities, unit 22nd. The most important thing related to this unit. Okay, so let's start discussing. The very first thing is the principle, cardinal principle of lending. When we are talking about the cardinal principle of lending, so there are seven cardinal principle of lending. Seven cardinal principle of lending means when the bank is lending to its borrower, okay, what are the things they have to consider, what are the principles based on which they have to give loan to their borrowers or to their debtors, okay, so as to avoid any type of risk in the lending. So what are the cardinal principle of lending? The very first thing is to ensure the safety of the money. Very simple thing. As a banker, as a bank, as a creditor, you have to look that your funds are safe. Okay, you have to look into the safety of your fund before lending. Then liquidity, your cash or your fund shouldn't be locked up for a very long period of time. You ensure that whatever the money you are giving, it is actually available in the most liquid form. It means that it shouldn't be locked up for a very long period of time. Third, if we talk about the profitability, of course, we have to look the profitability also. When the bank is decided or deciding to lend to its borrower, the first thing they ensure that the borrowing should be safe as well as it should be profitable. For what purpose you are giving the loan? Okay, so a bank should not giving the loan only just because the borrower is asking. I'm going to the bank, I'm saying that I want loan. I'm not specifying any purpose for which I have to borrow the loan. So the bank should not give me the loan. The bank should give the loan for the specific purpose. So the purpose is very important, and you have to put, as a debtor, you have to put purpose in front of the bank, that what which purpose you are going to take the loan. It is for construction or it is for buying your gold or jewelry, anything, but there should be a defined purpose. Okay, diversification of risk. Diversification of risk means when the bank is giving loans, the bank is advisable, or it is advisable for each and every bank, that they should not be giving loan in the particular sector, or they should not allocate every fund in a particular sector. No, because it is very risky. Sometimes that sector goes into the recession, so all the fund of the bank is locked as well as become unprofitable. And that's why it is advisable to bank that they have to lend in different sectors. There is a proper margin as well as there is a proper maximum limit that is defined, that you have to lend this much in the particular sector, so that if anyone goes into the recession, okay, or if any one sector becomes unprofitable, then you can earn profit from the rest of the sectors. Last, security. Then you have to check the security of the debtor also. And when you are checking the security of the debtor, then these include seven C's. These are very important. Now, what are the seven C's? First, you should look for the character. First, you should look for the what? You should look for the character. Character means whatever the debtor is, that character of the debtor is well defined. Means you should look to that what the past record of the debtor is good or not, or is clear or not, right? Second is the capacity. Capacity, you are judging the borrower's ability, whether they are able to repay the loan or not. Okay. Third, capital. Capital means the debtor should have enough capital to give back the loan or not. Collateral, what the collateral the debtor is giving to you when you are giving loans to the debtor. Conditions, on what terms and conditions you are giving loan to the debtor. Cash flow. Cash flow means from where the borrower is actually generating cash to meet the loan repayment. because every month they have to give EMI to the bank. So you must check that the borrower has enough cash flow or not cash flow to give the EMIs on a monthly basis to the bank or not. Last, the credit worthiness. Credit worthiness means the overall credit history of the borrower, so that you are assured that okay, this debtor should not is not a fraud, and they are giving you back the money, right? So these are the 7 C's on the basis of which you are judging the security of the debtor. So what are the 7 principles of lending? It is safety, liquidity, profitability, purpose, diversification of risk as security, right? And when we are talking about the security, how you can judge the security? So the judge for judging the security, we have 7 C's: character, capacity, capital, collateral, condition, cash flow, and credit worthiness, right? Now, what are the different types of borrower? See, now these are the different type of borrowers, and these are discussed in detail in the recorded video as well. Plus, we have discussed in detail about these type of borrowers in module A also, like individual. Individual are the borrowers, okay? Then proprietary firm means the firm which are actually owned and run by only one individual. Partnership firm. Under a partnership firm, we have limited liability partnership. Under limited liability partnership, we have small limited liability partnership, right? Then there is a Hindu undivided family in which the head is called as the Karta and the rest member are called as co-parceners, right? Then we have a limited liability partnership, a small limited liability partnership, and companies, public, private companies, public limited companies, private limited companies. We have discussed these type of borrowers in detail in the module A also, if you all remember that, what type of customers a bank is dealing. I think chapter second or third, no, third or fourth chapter in this, where we have discussed that what type of customers a bank is dealing with. Like a bank is dealing with individual, proprietorship firm, partnership firm, limited liability partnership, small limited liability partnership, right? So these are all that type of borrower. We already know what is individual, limited liability, small limited liability partnership, Hindu undivided family, etc. Next, types of borrower is one-person company also. Now, what is a one-person company? One-person company is a company which is actually run by only one person as its member. When the company is run by only one person, and a one-person company loses its status if the paid up capital exceed rupees 50 lakh, or the annual average turnover is more than 2 crores in the 3 immediate preceding consecutive years. It means that if you are a one-person company, then your paid up capital should be within 50 lakh, plus your annual average turnover for the last 3 preceding consecutive years should be less than 2 crore. And if you exceed this number, you lose the status of a one-person company. Then there is a small company. Small company is a company which is not a public company, other than a public company, in which the paid up share capital does not exceed 50 lakh, means your paid up capital should be within 50 lakh, and your turnover as per the last profit and loss statement is not exceeding 2 crore. Now here and here there is one difference. Paid up capital should not exceed 50 lakh, that is true. But in one-person company, your 3 immediate preceding consecutive years profit should be less than 2 crore. And here, your last profit and loss account, or last profit and loss account statement, in the last year, you have a profit of less than rupees 2 crore, right? Or turnover of rupees less than 2 crore. So that is a small company. Now, what is a government company? A government company is a company where the shares of the government is more than or equal to what? More than or equal to 51%. So if there is any company where the government share is more than or equal to 51%, then it is what? It is a government company. right? Now, there are different type of credit facilities. What are the different type of credit facility? First is a fund-based credit facility, then it is a non-fund based credit facility. Fund-based credit facility means where there is a direct flow of cash from the bank to its customer. For example, a bank is providing loan, a bank is providing overdraft, a bank is providing bill finance, a bank is providing a rediscounting facility to its debtor or customer, where there is a direct deposit of cash or actual flow of fund from the bank to its customer, right? Then it is a fund based credit. Whereas non fund based credit means whereas there is no direct flow of cash, means the bank is not giving cash to the customer. Instead of the direct flow of cash, they are providing indirect assistance, financial assistance to the customer. Like, for example, a bank is giving guarantee on the behalf of its customer, which is also called as a bank guarantee. A bank is actually writing a letter of credit on behalf of its customer. So that is called as non-fund facility, where there is no direct flow of cash. And in fund-based credit like loan, term loan, working capital loan, there is a direct flow of cash, direct deposit of cash from the bank to its debtor. Okay, now when we are talking about the term loans and demand loan, so it is a fund based facility, because term loan and demand loan, here you will see there is a direct flow of cash from the bank to its customer, right? Now when we are talking about the term loan and demand loan, term loan and demand loan, which are actually used for the purchasing of what, for the purchasing of your capital expenditure. Like, a business want to purchase some office area, a business want to purchase some machinery, some technology. So for purchasing this capital expenditures, for having this capital expenditure when you are building your asset, and when the loan is provided for the capital expenditure, then it is known as term or demand loan. Okay, and when we are talking about the term and demand loan, they are dispersed as a lump sum payment, because you have to make payment to the vendor for the purchasing of the machinery. In the term loan, it is repaid as a short term loan also, medium as well as long term also. When the repayment time period is within 1 year, then it is a short term loan. When the repayment time period is from 1 to 5 year, then it is a medium term loan. And when the repayment time period is over and above 5 year, then it is called as the long term loan. Acceptance facility means the bank is accepting, for example, bank is accepting that, okay, if the debtor, for example, if this person is not paying anything, okay, then on behalf of this customer, I will be responsible for paying EMIs or loans or anything. That is the acceptance facility. Acceptance means promise to pay from the bank side. Okay, now next thing, next is the working capital loan. See, term loan is for meeting your capital expenditure and is actually disbursed as a lump sum payment. But working capital loan is actually for meeting your day-to-day requirement. Like, a business want to give salaries to the employee, want to purchase raw material for the business, right? For this, there is a working capital loan that is given. Again, it is a fund-based credit. Second, when we are talking about the working capital is raw material, stored in spares, wages to the employees. There are different type of working capital like gross working capital and net working capital. Gross working capital means total fund required for what? Total fund required for your working needs. Okay, so what is the total fund that you need for maintenance or for your day-to-day activity, right? But net working capital means your current assets minus current liability. So this is a formula of net working capital: current assets minus current liability, right? Now, it is a general acceptance that if you have a high working capital, means if your working capitals are high, then your risk is actually lower because you have enough working capital. So it is like your risk is lower. But if your risk is lower, your profit is also low. So high working capital means low risk. Low risk means low profit. But if you have low working capital, it means you are engaged in high risk, right? But if you have high risk, means your chances of earning profit is also high. So this is the general acceptance. So higher the risk, higher the profitability. Lower the risk, lower the profitability, that you all know. Okay. Current assets are always less profitable than the fixed asset. Yes. Why? Because see, fixed asset like your machinery, land, your capital, that is your fixed asset. And fixed assets are always more profitable than your current asset. Current assets like your stock in progress, whatever the stock you have in progress, right? Raw material. So these are your current asset. So current assets are always less what profitable than your fixed asset, because when you are selling your fixed asset in the market, you will get a very good return, but not in the case of current asset. Okay. Third, short-term funds are less expensive like long-term fund. Why not? Why? Because see, when you are receiving any long-term funds from the bank, okay, you have to give them a high interest, right? If we compared it to the short-term fund, so in long-term funds, because the funds are locked up for a very long period of time, so you have to give more interest. And when you are giving more interest, it means that what it means that these are expensive. So long term funds are expensive, short term funds are less expensive. Okay. Now, there are some components of the working capital. Now, what are the components of the working capital? So, the very first component is raw material, the stock in progress, finished goods, consumable stores, your debtors, okay, and other expenses. So, these are your components of working capital. Now, there is a working capital cycle also, which is also known as operating cycle. So operating cycle is like your cash. You have your cash. You use this cash for purchasing raw material, right? Now your raw material is engaged into work in progress. Okay. Now from this you got your finished products. Now you sold this finished product to the market. Sometime you will not receive the cash immediately. So you have sold it to the debtor. After some time, the debtor will give you cash again. Now cash will again engage into purchasing of raw material, then raw material again into work in progress, then it is into finished product, then it is again sold in the market, maybe to the debtor, then a debtor give you again cash. So this is complete known as working capital cycle, or it is also known as the operating cycle. Clear? Now next thing, some fund-based working capital facilities. Now, fund-based working capital facilities in which you have a cash credit. First of all, you have a cash credit. Now, cash credit is where the borrower is allowed to withdraw funds up to a specified limit. Now, there is a difference between cash credit and overdraft. Listen carefully. When we are talking about the cash credit, it means that the borrower is allowed to withdraw money up to a specified limit. Bank has actually given them a specified limit over and above the balance of their account. Okay. And you are allowed to withdraw money up to that certain limit only, not more than that. Then it is known as cash credit. Okay. Whereas overdraft limit is when the bank has given you the permission that you can withdraw money over and above your account balance without any limit. Okay, so there is no certain limit that has been specified in case of overdraft. Okay, whereas in cash credit, there is a specified limit. Like, for example, in my account, bank has given me a cash credit of 1 lakh. It means that over and above your account balance, you can withdraw up to rupees 1 lakh from your account. Whereas in overdraft, this 1 lakh limit is not given. Bank has given me the flexibility that you can withdraw over and above your account balance. Okay, that is called as overdraft. Now, bill finance and bill discounting. In detail, I have given you the concept in the videos, right? Because this concept I'm not touching here, why you will get confused. Okay, and I don't want to confuse you all that what is the difference between bill finance and bill discounting. So a detailed discussion is given in the recorded video. You have to see that recorded video. Bill finance and bill discounting has is actually very important for all of you, and the difference is also very important. I will be giving case studies question based on bill discounting and bill finance. Okay, so don't forget to learn this concept from the recorded video. Okay, I'm not touching here. Why? Because I don't want you all to confuse here. Okay, next, letter of credit. Now, what is letter of credit? Again, we have a detailed letter of credit chapter unit coming in this particular module. Okay, so I think unit 27 and 26, it is letter of credit. So I will be discussing in detail what is letter of credit in that upcoming slides. Okay, so wait for that. Bank guarantee, again a detailed chapter, but I'm just giving you an idea of bank guarantee here. What is bank guarantee? Bank guarantee is when there is a principal debtor, when there is a creditor, and when there is a third person which is known as surety. And in the case of surety, it is bank. Means what? For example, A and B is there. Okay, and A has given loan to B. Okay, now B promised to repay this loan to A. B promised to repay this loan to A. Now, but the amount is very big, the amount is very substantial. So, A wants that on behalf of B, B bank should give a guarantee that if B defaults on payment, that on behalf of B, bank is responsible for making the payment. Right? So, A is giving loan to B. Okay, so A is called as what? Creditor. B is the principal debtor. Okay, now the primary responsibility is that this principal debtor means B has to make payment to A, but the amount is big, so A actually demanded for a bank guarantee. So on the behalf of B, B's bank give guarantee to A that in case B defaults on payment, that I will be responsible for paying back the money. So here B is giving surety, B is giving guarantee, bank is giving guarantee, so this is known as the surety. Okay, so normal guarantee means when this surety is any other individual or anyone, right? But in bank guarantee, this surety is necessarily to be a bank. Okay, so that is known as bank guarantee. Okay, so this is the complete chapter. Non-fund based facilities, fund based facilities, type of borrower. Then there are the principle, cardinal principle of lending. Now, if you have any doubt in this whole chapter, please feel free to ask your doubt. Everyone, any doubt? Shirish, Anju, Hema, Smriti, everyone. If you have any doubt till here, please ask. Okay. Now, just don't forget to see this. What is the difference between bill discounting and bill financing? This is very important. Letter of credit, I will be discussing in unit 27 in this video. Don't worry. Okay. Other than that, if you have any doubt, whatever I have explained, just kindly ask your doubt. Seven principle of lending, very important. Seven C's of security. Very important. Any doubt? Everything is clear? Ruchi, Anju, Smriti, Hema, Shirish. No doubt everything is clear right now? Okay, good. Now, next chapter. Let's move to the next chapter. That is appraisal and assessment of credit facility. This is unit 23. Now, let's start discussing this. First of all, when we are talking about the credit appraisal technique. Now, what is credit appraisal? Credit appraisal means when the bank is actually taking decision whether to sanction the loan or not. means the complete process in which the bank is receiving the proposal of the credit, okay, that any one borrower want to have a credit, right? Now, the bank is evaluating the overall profile of the borrower and then taking the decision whether to give them loan or to reject that proposal. That complete process is called as the credit appraisal. Right now, there are different steps in the credit appraisal. While accepting or rejecting the proposal of a particular loan, the bank is actually going through different procedures, and on the basis of different procedure, bank is judging whether to accept or reject this loan facility, right? So first thing is the validation of proposal. Whatever the proposal the bank has received from the applicant, first of all, the bank is actually verifying and validating the information that is given by the applicant. Okay, so I actually fill the form. My name is Afreen Azmat, my pan is this, I want to have a loan. Okay, whatever the information I have provided from my side in that proposal to the bank is actually first verifying and validating that particular information. Okay, second, the information is cross checked with my supporting documents. If my name is Afreen Asmat, my Aadhaar should be checked that okay, I am Afreen Asmat or not, right? Field verification if necessary. What is my address? Okay, so field verification is done. Checking required approval and license. It means that, for example, I want to borrow a loan for setting up a particular unit or industry or factory. So for that purpose, if I have a license, a valid license from the government or not, if I want to set up an industry, so for setting up that industry, I have permission, approvals, or license or not. That is checked. Okay. Then verification of the applicant's capacity to borrow or to request the loan is necessary or not. It means that my capacity is checked as a debtor. If I am asking a loan of rupees 10 lakh from the bank, then the bank should check that whether I am able to repay that loan or not. I have that much cash flow or not. I am earning or not earning. So, this is the process of validation of proposal. Then, credit risk. What is credit risk? Credit risk is actually a probability of defaulting by the debt, means how much chance is there that I am not going to repay back the loan. That is called as the credit risk. So, obviously, the very important step before accepting any loan request is to check the credit risk in that loan. Okay, what are the chances of the default in that case? Okay, next, credit risk rating. Okay, credit risk rating is actually the first parameter on the basis of which the bank is taking decision whether to accept or reject the proposal. Why? Because if you have a good credit risk rating as a borrower, then obviously the bank is eager to give you the loan. Okay, but if you don't have a good credit risk rating, obviously the bank is putting or pushing themselves back to give you the loan. So credit risk rating is a very important parameter or is a standard or mark for judging the credibility of the borrower. Then criteria for the decision. What is the complete criteria for the decision? First, the credit score is checked. Your credit score is checked. Okay, so usually 750 and above. If you have the score of 750 and above, that score is considered as fit to give you the loan, right? Second, the lender will also check the purpose. Okay, means for what purpose you are borrowing the loan, and if that purpose is fitting with the purpose of the bank or not. Maybe the bank is not willing to give loan in that particular area, so the bank can reject that applicant also. But if the purpose is fitting with the purpose of the bank, then the bank is giving you the loan. Third, the bank will also check that it will not breach the concentration limit of the loan. It means that I have told you that bank has to diversify their risk. And for diversifying their risk, bank has a proper limit, specified limit in each and every sector, that bank has to give this much loan in each and every sector. Why? So as to avoid the risk, because if any one sector goes in recession and bank has deployed all the fund in that one sector, so obviously bank becomes unprofitable, and so there is a specified limit in each sector. So if, for example, there is in one sector the limit is full, okay, now bank don't have any more margin to give in particular this sector loan, and a loan application is coming asking for loan in that particular sector. Now if the bank is accepting that loan request, it will breach the concentration limit of that particular sector. So in this case also, bank is rejecting the request of the loan because it don't want to breach the specified limit. Clear? So these are the criteria for taking the decision. Then, aspect of appraisal. We have discussed the seven C's of security in the last chapter just now, and we have discussed the four cardinal parameters of lending. Even we have discussed the seven cardinal principle of lending, right? So security, for judging the security, we have seven C's. And what are the seven cardinal principles of lending? We have discussed in the previous chapter. Seven C's are credit worthiness, character, capacity, capital, collateral, condition, and cash flow. Clear? Now next thing, 750 or 700, check it, it may be 700 or 750. I remember 750, maybe it is 700. Just recheck it once, okay, Shirish? Next, now this is very important. See, I'm telling you, in the video I have given you two numerical questions from here. I have explained everything in that numerical question, right, in the recorded video. Proper numerical question is coming from the turnover method as well as operating cycle method. So there are two ways for assessing the working capital requirement. First is the turnover method and second is the operating cycle method. And in the recorded video, I have given proper example plus numerical plus the detailed discussion, based on which you have to calculate numerically what is the working capital requirement of a particular fund, right? Now here I'm just giving you an idea of turnover method. I am not going to give you any numerical because I know that in the recorded video I have given a complete half an hour session especially for this formulas and for this operating cycle method. Okay, so you have detailed video, check out that detailed video there. But you have to remember certain things, okay? First thing, if you are micro or a small enterprises, remember this, very very important, right? Each and every point in this is very important, okay? If you are a micro and a small enterprises, then your working capital limit is up to rupees 5 crore if you want to receive it from the bank. So for a micro and small enterprises, the working capital limit is up to rupees 5 crore, not more than that in any case. Okay. Second, for a normal business other than micro and small enterprises, how to calculate the working capital requirement? So first of all, the borrower's overall working capital requirement is always 25% of the projected annual turnover. This is fixed, 25%. Projected annual turnover you have to calculate. Like for example, I am saying that my company has a turnover of rupees 1 crore, or simple number, take simple number, 1 lakh. My company has a turnover of rupees 1 lakh this year, and I am expecting a growth of 25% in the next year. Okay. I have said that my company has a turnover of rupees 1 lakh this year, and I expect a growth of 25% in the next year. So my projected annual turnover for the next year is 1 lakh plus 25% of 1 lakh, because I am saying that I am expecting a growth of 25% in the next year. So this is 1 lakh plus 25,000. It means that my projected annual turnover is 1 lakh 25,000. And when I am asked that what is your working capital need? So working capital is always 25% of the projected annual turnover. So this is the projected annual turnover, 25% of 1 lakh 25,000. It is my total working capital need. Okay. Now, whatever is my total working capital need, bank is providing 20% of the PAT as a loan to me, and the rest 5% of the PAT I have to take, or I have to invest by myself. For example, if my projected annual turnover is 1,25,000 and the 25% of 1,25,000 is my total working capital. For example, my total working capital need is, for example, 90,000. For example, okay. Now, in this 90,000, 20% is actually funded by the bank, or my PAT is, for example, 1 lakh. So, in this 1 lakh, 20% of the PAT is given as a finance or as a loan from the bank side as my working capital. And 5% of the PAT I have to invest by myself as a working capital in my firm. So total is 25%. So 20% is given by bank, 5% is by myself, and total is 25%, which is the total working capital. So this I have explained in detail, very important part of this chapter. Don't miss out it. Okay, so see the recorded video and see the unit number you will get. Okay, it is unit 23. Okay, so don't miss out. Okay, so this is the complete chapter for this. Okay, if you have any doubt here, kindly ask everyone. If you have any doubt here, kindly ask everyone. Any doubt? Yes or no? Smriti, Anju, Gopal, Shirish, Ruchi, everyone. Okay, now this detailed thing I have given you in the recorded video, so you have to see there for detailed numericals plus example plus how to calculate. Okay, for selection batch we completed section B. Shirish, maybe yes, yes, in the selection batch you have completed module B. If you have completed module B, that it is very well and good. Okay. And if you haven't completed module B, then for the success batch, I have given you the what recorded video. So selection, yes, selection batch, in the selection batch, I have given the module B, right? And whoever are the new batch, means the success batch student, you have the recorded video. Okay. Next thing, operational aspects of the loan account. Okay, so this is unit 24. Let's start discussing this. First of all, the credit management. Now, what is the credit management? Credit management is loan appraising plus sanctioning. What is loan appraising? Loan appraisal means the evaluation of the loan request. We have discussed in the last unit that when we are evaluating the loan profile completely, whatever the request, whatever the proposal bank is receiving from the customer side, okay, whether to accept that or to reject that, right? So that complete process of whether to accept that proposal or not, that is the loan appraising. So from the process of loan appraising till the process of sanctioning the loan, plus monitoring the account whether they are able to recover or whether they are able to pay back the loan or not, the complete process is called as the credit management. Credit management includes credit appraisal, means the validation of the proposal, plus the decision whether to sanction the loan or to reject the loan, plus the monitoring of the loan account. So the complete process is called as the credit management. Okay. Now, what is the credit appraisal or exposure? So the credit exposure is actually the potential loss the creditor can have if borrower doesn't pay. So credit exposure is what? For example, a, debtor has actually given a collateral of rupees 2 lakh to the bank. Okay. And the bank has given the loan of rupees, for example, 3 lakh. Now, in this case, if the borrower defaults, then there is 1 lakh rupees which is not covered by the collateral in this case. So the maximum potential loss the creditor can incur if the borrower defaults on payment is rupees 1 lakh. That is the credit exposure. Means what is the maximum potential loss a creditor or lender can suffer if the counterparty fails to repay the loan. Okay. Now, what is credit monitoring? Credit monitoring is monitoring the accounts of the borrower and the financial health and the credit worthiness of the borrower, that whether they are able to repay back the loan or not. That is the credit monitoring. So credit monitoring plus credit appraisal plus sanctioning all together is called as credit management. Okay. Next, scrilic, central repository on information on large credits. Very important. CRILIC is actually a centralized database which is created by Reserve Bank of India, and it is actually to capture, maintain and store the information on the large borrower. So if you are a large borrower means if your total exposure is rupees 5 crore and above across all the banks in India, if you as a total borrowed a loan of rupees 5 crore and above from different banks across all over India, then you are considered as a large borrower. And for storing, capturing and monitoring your information, the government or Reserve Bank of India has actually maintained a centralized database that is known as CRILIC to just evaluating your profile, that if you are able to repay back your loans or not. That is known as CRILIC. Banks are required to submit their data to CRILIC on monthly or quarterly basis. Now, if you have a loan account of 500 million or above, means 50 crore and above, then your account is considered as a red flagged account. Means 5 crore and above, so you are a large borrower. And for maintaining your data, there is CRILIC, which is maintained by Reserve Bank of India. But if you have a loan account which have of rupees 500 million and above, then you are a red flag account. Means your chances of default is very high. Okay, you are a very risky borrower. That is called as a red flagged account. Okay, next. CERSAI, very important. Full form of CERSAI is Central Registration of Securitization, Asset Reconstruction and Securities Interest of India. That is known as CERSAI. Now, CERSAI has 51% shareholdings by the central government and selected public sector bank. And CERSAI is actually maintained for two main purposes: securitization and asset reconstruction. Now, what is securitization? Securitization means pooling together the large number of financial assets of the bank and converting them into the tradable securities. It means that, see, whatever the loans bank are giving, it is the asset for the bank, because bank is earning money from that loans, while it is acting as a debt, okay, as a liability for us debtor, right? So bank has a lot of assets, because they have given lot of loans and they are earning from that loans. So when all the assets like loan and mortgage and receivables of the bank, they are pooled together and then they are used as a tradable security for securing investment of the bank. Means bank lend these asset as a collateral to another for meet or for attracting investments in the bank. Then it is called as securitization. Asset reconstruction means acquiring the non-performing asset from bank and financial institution and then taking measures to recover the maximum possible value from that non-performing asset. That is called as asset reconstruction. Okay, so for asset reconstruction means for taking over the non-performing asset of the bank and for securitization of the bank. Okay, for this purpose, CERSAI has been formulated or formed. Okay, and it is a government operating company. And CERSAI has 51% shareholding by the central government and other public sector bank. Clear? Now, next. What are the operational process of handling loans? Means what are the process of handling loan? First, the bank is receiving the loan application as usual. Then they are assessing the viability and credit worthiness of that particular loan request. Then they took the decision whether to sanction or reject the loan, and if they have taken the decision to sanction the loan, then they are dispersing the loan. And after disbursement, they are monitoring and supervising the loan account. So this is known as the process of handling the account. Clear? Next. Now, there are some common loans that we are going to discuss here. First is the education loan, the most common type of loan which is given by a bank. First of all, bank took no margin if the loan is up to rupees 4 lakh. Margin means what is the amount that you are investing by your side as a debtor. For example, I am purchasing a car of rupees 20 lakhs. Okay, and if I am taking 15 lakh rupees as a loan from the bank and 5 lakh rupees I am investing by myself in that car, that is called as margin. Margin means what the bank is demanding from you, that you also have to invest that much from your side. That is called as the margin. And if education loans is concerned, and if you are borrowing education loan of up to rupees 4 lakh, no margin is required from your side. Okay, but if you are borrowing the loan above 4 lakh and up to 7.5 lakh, bank can demand 5% margin for the studies in the domestic country. Means if you are studying in India, and 15% if you want to study abroad. And scholarship and assistance, if as a student you have got some scholarship for studying abroad, you can include that scholarship in your margin account. Okay, so if you have to invest rupees 1 lakh as a margin from yourself which the bank has demanded from you, and you have received 75,000 as a scholarship, so you just add 75,000 from that scholarship, 25,000 by yourself, and 1 lakh rupees as a margin, as a total margin from your side into the bank, right? Now, margin, it can be given as an year on year basis according to your admission fees. Okay. Now, no security and collateral is insisted if the loan is up to rupees 4 lakh. Okay. But if the loan is over and above 4 lakh and up to rupees 7.5 lakh, bank can demand a third party guarantee also. But this third party guarantee thing can be just rejected by the bank if the bank is very well aware of your net worth. Means if the parents are wealthy and they know that, bank know that they are able to repay back the loan, then bank may just reject that third party guarantee. They don't have that third party guarantee, right? In the case of the education loan, you are borrowing the education loan and you are purchased the computer. Okay, so this computer is hypothecated to the bank. Hypothecation means it is given as a collateral to the bank. Now, in the case of hypothecation, you don't have to transfer the ownership or the possession to the bank. The possession is with you, means I am using that computer, but it is hypothecated to the bank. It means that in case of my default, the bank will take over the possession of this computer and sell it in the market and recover the loan. That is known as hypothecation. Hypothecation is always related to movable properties. Like I can hypothecate my car, I can hypothecate my computer, okay, but I cannot hypothecate my house because house is not a movable property. In case of house, it is mortgage. Mortgage is actually related to immovable property. Hypothecation is related to movable property. Clear? Now, the repayment of this education loan is whatever your course period is, like 3 or 4 years plus 1 year moratorium. Okay. Now, repayment of loan, it is actually in the monthly installment, and it is can be done for a period of 15 years for all categories. So education loans can have a repayment type period of as high as 15 years also. Okay. No processing and upfront charges if the loan is up to rupees 7.5 lakh, and over and above 7.5 lakh, bank can decide to have their own processing and upfront charges. Okay, this is the education loan. Next, vehicle loan. For the purchasing of vehicle, if you want to purchase vehicle and you are borrowing loan from the bank, that is known as the vehicle loan. That can be given for purchasing of the new car, as well as if you want to borrow the second hand car also, then the vehicle loan is given to you, right? Now, vehicle loan, always remember, cannot be given to the individual whose age is 65 years and above. Okay, the maximum tenure or the return time period is 84 months. And what is the loan to value ratio? If you are borrowing any vehicle where the amount is up to rupees 1 lakh, means your valuation of that asset, or means your on road prices is up to rupees 10 lakh, and you are borrowing the loan of up to rupees 10 lakh, then what is the maximum permissible loan to value ratio is 85% of your on road car price. So if your car is more than rupees 10 lakh, then bank can just give you as maximum as 85% of on road price as a loan. Rest 15% you have to make payment by yourself. Okay. And if, sorry, up to 1 lakh, and if it is over and above 10 lakh, then bank is giving you 80%, max to max 80% as a loan. Rest 20% you have to invest yourself. So if the um, amount of car is within 10 lakh, then the loan to value ratio is 85%. Means if your car is for rupees 5 lakh, bank is giving you as maximum as 85% of that 5 lakh as a loan to you. Rest you have to invest by yourself. Okay. And if it is above 10 lakh, then bank is giving you 80% of the on road price of the car price, and rest 20% you have to invest by yourself. Okay, so this is the complete chapter. Now if you have any doubt, kindly ask. See, I have just given you the most important thing related to this chapter. Detailed videos, you have detailed videos with yourself. Kindly go through that detailed video for each and every detailed discussions, right? Now if you have any doubt here, kindly ask. Everyone, any doubt? Done? Good. Now next thing, let's talk about the types of collaterals and their characteristics, Unit 25. Now, types of collateral, let's talk about secured and unsecured loan first. Okay, secured loans which are actually given under the security, means you have given something as a collateral, and on the basis of that, when the loan is provided to you, then it is a secured loan. Unsecured loan is actually given without any collateral or security. You know that secured loan are less risky. unsecured loans are more risky. Because unsecured loans are more risky, so they are more expensive, means it means that high interest rate is demanded in the case of unsecured loan, whereas in secured loan, low interest rate is actually demanded. Okay, next, type of securities. So we have different type of securities, like immovable assets is given as a collateral to the bank. Movable asset, actionable claim. Actionable claims means where you can just claim the money through legal process. Okay, like the insurance. Okay, for example, I uh, put my insurance thing as a collateral to the bank. It means that when insurance company give me the money, bank has all the right to legally claim that money from me. That is known as actionable claim. Intangible assets can also be given as a security to the bank. Right now, when the banker is accepting anything as a collateral, they need to check some of the characteristic. The first characteristic is they need to check that whether it is sellable or not sellable. Like some antique item, when we are talking about some antique item, it is not sellable in the market. There is not a proper market for the antique items because their values are hard to determine, right? So this is not sellable. So bankers should avoid taking these type of assets as a collateral where you don't find a good market for the selling of that. Okay. The value should be ascertainable. It means that you have the value of these securities. You can just take the value of the security in the money form. Okay. Means you can uh, ascertain, or you can say you can just determine the value of security in the market. Okay, this have some security, or this have some value in the market. Okay, it should be reasonably stable. It means that they are not fluctuating widely. Fourth, it can be easily transferable. If you are selling that thing to another person, the possession should be easily transferable to another person. So if any asset is sellable, the value should be ascertained in the market. It should be stable, as well as it can be easily transferred to another person. These collateral are taken as a security by the bank. Right? Next. Now, land and building. Sometimes land and building are taken as a security. First of all, if we talk about the time period before this 10 years or a decade, okay, bank were very skeptical to actually accept this land and building as a collateral in the early days. Why? Because selling this land and building was a very big task at that time. Plus, the court, there were a lot of formalities in case the borrower defers on payment. Bank has to go through a lot of formalities before selling this land and building to recover their loans. So, bank were not easily accepting land and building as a collateral. But when the SARFAESI Act has been introduced, okay, after the introduction of SARFAESI Act, because the bank has given this flexibility under the SARFAESI Act that if the borrower defaults, the bank can sell the immovable property without the intervention of court. And because of this flexibility, now banks are easily accepting land and building as a collateral. There are some very good profits behind this land and building, because you know that the value of land and building increase every day. Okay, so this is a very good way in terms of value, because bank can easily trace that land and building. Okay, plus the values increasing, so bank nowadays is happily or are happily accepting land and building as a collateral because of the SARFAESI Act flexibility, because of its value, and because of its traceability. Okay, now next thing is goods. When we are accepting goods as a security, what are the precautions the bank should take? First of all, the bank should see that from which industry you are taking that goods as a collateral. That industry should be dealing in that goods for a quite some times now. Means, for example, a company just entered into that manufacturing thing 1 month ago, and you are accepting that as a collateral. Now you are taking risk. Okay, if that company is dealing in that good for quite some time long, like 2 3 year or 4 year or 5 year, then you can easily accept that goods as a collateral, right? Now, whatever the loan you are giving against the good, it should be a short term loan. Why? Because see, goods have a value which last for a shorter period of time. Goods can easily run out of fashion. Their quality and you can say their quality is likely to diminish in the future, right? For example, furniture. Okay, furniture, if you are just keeping the furniture for 5 years, you know that your quality is decreasing day by day, your value is decreasing day by day. Plus, this furniture will run out of fashion after 5 years, right? So, for that furniture, you cannot afford to give long term loan to the borrower. Max to max 1 year, it is enough. So, the loan, whatever the loan it is given for the goods, it should be a short term loan. Okay, or the bank can take the absolute or constructive possession of that good. Sometimes the bank is taking the actual possession of that good, sometimes the bank is taking the constructive possession of that good. If the good is hypothecated, hypothecated means when you actually transfer the possession, when you doesn't transfer the possession of the goods. Okay, now bank should take in writing that whatever the goods you have hypothecated, you cannot give it to another bank. It means that, for example, I have this laptop. Okay, now I have hypothecated my laptop to the bank. It means that I haven't given the possession of this particular laptop to the bank. The laptop is with the debtor. Okay. Now, in this case, bank should always keep in or take in writing that if I have hypothecated this laptop as a collateral to the bank, it means that I am not going to give or sell this particular laptop to anyone else because it is hypothecated to the bank. If there are goods which are pledged, pledge means you actually transfer the possession to the bank, right? Now, in this case, the bank should take reasonable care because this is actually a collateral. So, bank, if taken possession of that good, the bank should be responsible for taking care of that particular good against any damage. Okay. Plus, bank need to see that the goods are well in demand. The age of the stock should be considered, means the goods are not very old. Okay, and margins should be kept. So these are the precautions that should be taken if you are lending any advances against the goods, right? Now, next thing, in case of default. Okay, now in the case of default, there are two things. If the goods are hypothecated, okay, it means that the possession is not with the bank, so bank need to first take the possession of that good and then sell in the market and then recover the money. Okay, but if it is pledged, it means that bank has already the possession. Okay, so bank has to give a reasonable time and notice to the debtor that if you not pay the loan within 10 or 15 days, then I am going to sell that goods. Okay, now after giving reasonable notice, the bank is allowed to sell that product in the market. Okay, so hypothecation and pledge. Hypothecation and pledge, they both are related with the movable assets. The thing is, in hypothecation, you haven't transferred the possession, but in pledge, you have transferred the possession. Clear? Next, advance against life insurance. Yes, life insurance policies are given as a collateral by the debtor to the bank. Okay, and it can be primary or a collateral security. Primary means all alone life insurance policies is acting as a collateral for the loan. Alone. Collateral means this is a secondary one. Means, for example, I have given this as a collateral, plus the life insurance policy. So in this case, it is a collateral security. But if I have given all alone life insurance policy as a collateral, then it is a primary. And it is an actionable claim. It means that if the bank is there and I have received the amount of that life insurance policy, bank has all the right, legal right, that they can legally claim that money from me. It is an actionable claim. Okay. And because the life insurance business are highly regulated market, Insurance Regulatory and Development Authority of India is actually regulating all the insurance business in India, so it is less risky. And this needs a very low formalities to transfer the policy in the name of bank. So bank are easily accepting life insurance policy as a collateral. But there are some type of policies which are not acceptable as a collateral, like children endowment policy, deferred policy, like for example you have taken any policy for the estate duty, or if you have any policy of the Married Women Property Act. So these are some policies, because of the complicated terms and conditions, bank are not accepting these policies as a collateral. Clear? Now next, advance against shares. Yes, advances or loans can be given against the shares also. Bank are accepting shares as a collateral also. Now there are two type of share. You know that equity and the preference share, right? Now equity shares, where preference share means you are not the fractional owner of that company, you don't have the voting right, you don't have the right to participate in the management decision. Okay, so there are two type of share, equity and preference share. Plus the shares can be listed as well as unlisted. So if you have a listed equity share, bank are accepting collateral of listed equity share and giving you the loan, as well as bank can accept the listed preference share also as a collateral. Okay. Okay, next, bank can give demand loan or overdraft also as a security for that shares. Okay, second, shares are also accepted as a collateral for advances. The nature is pledge. Now in pledge, you know that you have to transfer the possession to the bank. So if you are taking loan against shares, you have to transfer the possession of that shares to the bank. Okay, and you have to transfer the possession in the demat form. Demat form means electronic format. Okay, and advances are given against fully paid shares also, and no advances is given against the private share limited companies. So if you have a public limited company share, then only bank is accepting the shares for the collateral. Private limited company, if you have a shares of any private limited company, bank are not accepting the shares of private limited company as a collateral. Clear? So these are the advances against the shares. Okay, next, loans against the term deposit. So if you have any FD with the bank, then yes, bank are giving loan against that FD. But one thing important to note, if you are taking FD loans, means you are giving your FD as a collateral and taking your loan, the FD should be maintained in the same bank. Means if your FD in the HDFC bank and you are borrowing loan from the HDFC bank, then yes, you are allowed to borrow. But if you have FD in the HDFC bank and you are borrowing loan from SBI, you are not allowed to. SBI will not give you the loan. Why? Because FD, if you have FD in the same bank, then only the bank is giving you the loan. The charge here is pledge. Pledge means you have to transfer the position to the bank. 90% is the loan ratio. It means that if you have an FD of rupees 1 lakh, okay, then 90,000 up to rupees 90,000 is given as a loan. Okay. Now, in the case of minor, now this is very important to note. Very, very important to note. Now, if you are a minor, so loan can be given to the minor against the FD if it is taken for the necessity. So if it is taken for the necessity, the loan can be granted against the FD. But if it is taken for any other purpose other than necessity, then no loan is granted against the security of the deposit in the name of minor. Okay. So if there is a FD of a minor and minor want loan for the necessity, then bank is allowed to give. But if it is not for necessity, bank cannot give the loan in the name of the minor's FD. Okay. So this is the loan against term deposit. Stocks based cash credit comes under good. Stock based cash credit means what? What you want to ask, Gopal? I actually didn't get your question. Okay, next, gold ornament. Very simple thing. You can just give gold and borrow loans from the bank. Charge here is pledge. Pledge means you have to transfer the possession to the bank, right? Now, it is 75%. Means if you have deposit a gold of rupees 1 lakh to the bank, bank is giving you a loan of 75,000, not more than 75,000. Plus, in if you have any raw gold, okay, raw gold or billion gold or pure gold, loan is not given against that. But if you have a gold coin, minted gold coin, then yes, bank can give you loan against that gold coin. But if you have raw gold, bank is not giving you the loan against raw gold. Okay. How much younger minor is talked here? 10 years and above, plus bank are free to decide their age. It is same like opening the account, right? 10 years and above, but bank are free to decide the age. Okay, done. Okay, vehicle finance. Yes, bank are giving you the loan for vehicle finance also. Now, in this case, you have to hypothecate the vehicle. Now, hypothecation means you don't have to transfer the possession. Hypothecation means you don't have to transfer the possession. For example, I have hypothecated my car. It means that I have secured a loan against my car, but the car is in the possession of mine. I am using that car, but if I default on a loan, the bank has the right to take the possession and sell that goods and what? And recover the loan. Right? So this is the vehicle loan. Clear? Now, if you have any doubt in this whole chapter, kindly ask everyone. Everyone, if you have any doubt in this whole chapter, please ask everyone, you guys. Everyone, if you have any doubt, please ask. No doubt, just please give me a thumbs up. No doubt, everything is clear till now. Okay, so can I take a 5 minute breaks here, everyone? Can I take a 5 minute break here, everyone, you guys, please? Okay, so let's take a 5 minute break and I will continue the rest after 5 minutes. Okay, everyone? Okay, just 5 minute break and we will continue after 5 minutes. Okay, good. Okay. Am I audible to everyone? Yes or no? Am I audible to everyone? Yes or no, guys? Hema, Mohan, Gopal, Anju, Shirish, Smriti, everyone. Am I audible? Yes or no? Okay, so I think let's start discussing then. Okay, different modes of charging securities, right? So let's start discussing this different mode of charging securities. First of all, let's talk about the contract. Okay, so what is an contract? Everyone. Okay, so contract, first of all, is any agreement which is enforceable by law. Contract is an agreement which is enforceable by law. It means that if there is a default from any one party, you can just stretch that party to the court. Okay, so that is enforceability. So it has two major things. Contract, first of all, it is an agreement between two parties. Second, it should be enforceable by law, means there are rights and obligations that arises out of law. Okay, which means that first of all the parties should have a free consent. Okay, there should be a lawful consideration. Lawful consideration means there should be anything which is in written. Okay, lawful consideration for some lawful object and consideration, there should be an agreement. Okay, and it should not declared as wired expressively in the Indian Contract Act. For example, in Indian Contract Act, if you are insolvent, okay, if you are of unsound mind, if you are minor, okay, you are actually declared as insolvent. Okay, sorry, if you are insolvent, if you are of unsound mind, or if you are minor, you are not allowed to enter into contract. So you are expressively considered as unvoid, or expressively declared as void. Okay, under the Indian Contract Act. So first of all, the contract should be an agreement. It should be enforceable. It should be made with the free consent. It should have a lawful consideration, anything in written, lawful, anything in written. Next, there should be a lawful object. Okay, last, it should be not declared as expressively void. Okay, in the Indian Contract Act. Next, this is very important page for all of you. Okay, now contract and agreement. So I have told you that contract is an agreement which is enforceable by law, right? So if we talk about this thing, a line comes that all contract are agreement. All contract are agreement, but all agreement are not contract, because if there is an agreement, for agreement to be a contract, the enforceability is must, right? So if we talk about this particular thing, if we talk about this particular concept, that contract and agreements, agreement is a bigger term. Agreement is actually a bigger term. Under agreement, there are lot of agreements which are not enforceable by law. There are lot of agreements which are enforceable by law. So those agreements which are enforceable by law are called as contract. So if we talk about contract, all contracts are under agreement, but all agreement are not contract, because for all agreement to be a contract, enforceability of the law is must. So this is an agreement, this is enforceability, and when they intersect, this portion is called as contract. So if you see this portion, all contracts come under the whole agreement, but all agreements are not contract, because this is that portion which is not enforceable by law. So agreement is actually a bigger term. Okay, under agreement, you will find enforceability also and non-enforceability also. So, under agreement, what are those contracts which are enforceable? So, all the enforceable are considered under the contract, right? So, always remember, all contract are considered as agreement, but all agreement are not considered as contract. Okay. Now, what are the essentials of the valid contract? First of all, there should be a proposal and there should be an acceptance. Okay, so there should be a one person who is proposing and there should be an acceptance from the other person. Agreement can be in written or oral. There should be a consideration, means in written of something. It should be made with a free consent, and there should be a party who have the capacity to contract. It means that you are not insolvent, you are not of unsound mind, you are not minor, right? So you should have a capacity to contract. Now, in case of minor contract is void ab initio. It means that it is invalid from the very first step, because a minor is not allowed to enter into a contract according to the Indian Contract Act, right? So if you are doing any contract with the minor, it is invalid from the very first step. Okay. Now, next, contract of an agency. Now, you know that what is agent and what is principal. You know that agent is one person who is acting on the behalf of the principal. Principal is the one person who is giving instruction to the agent to perform some function, right? And agent and principal, these are defined under section 182 of Indian Contract Act, right? Now, what are the authority of the agent? So if I'm acting as an agent of the principal, what is an authority of mine? First of all, my authority can be express or implied. It means that the principal can just give in written that what are my area of working, or it is implied or understood. Okay, for example, if Hema is a class monitor and if I am absent from the class, it is implied, understood that in my absence, Hema is required to take care of this class, right? So this is implied, which is already understood from the situation. Express means it is written in contract or it is expressed, right? Extent means the area of working should be defined. In case of emergency, what is the power of the agent? No delegation. It means that if I am giving any power to Hema cannot transfer this power to Smriti. Okay, so agent cannot transfer their function to any other person. That is known as delegation. No delegation in the case of agent principal relationship. And in case if that agent acted beyond his or her power, then what is the role? So these should be the authority of the agent. Okay, next. Contract of bailment. Now, what is bailment? First of all, bailment is actually a delivery of good from one person to another for carrying out some specific task. Like, for example, I have a car and I am leaving for USA tomorrow. Now, I want to ensure the safety of that car. So, I have delivered that car to a garage for the safety of that car. So, it is called as the contract of bailment because I have delivered that good to the garage for the safety and security of that car. The person who is delivering that good means I am delivering that good. So, I am called as a bailer. And the person to whom the goods are delivered are called as the bailee, right? Now, what are the features of the bailment? If we got features of the bailment, first there is a contract of bailment. What is the meaning of bailment? That we have already discussed. Then disclosure to the bailee, it means that I am delivering that car to the garage, and if that car has some default, like for example, uh, one tire of that car is punctured, so I have to inform that to the bailee, right? Next, taking care of the goods. Obviously, bailee is responsible to take care of the goods completely in the absence of a bailer. Now, duties of the bailee. What is the duty of that garage? First of all, to return the goods as soon as the task is completed. Second, to if there is any loss, to that particular goods, okay, the bailee is responsible for compensating of that loss, okay. And if there is any absence of contract, the bailee is responsible to deliver back that goods to the bailer as soon as the task is finished. Plus, if you have received some profit from that particular car, for example, in my absence, I have given the permission to the garage that you can just rent out my car, and that particular garage has actually earned 1 lakh rupees from that car in my absence. So if there is no contract, the bailee to whom the goods is delivered, means that garage is responsible to return that increase in the profit, like 1 lakh rupees, to me, okay. That is the duty of bailee. Now bailee lien, what is bailee lien? Bailee has all the right to retain the possession of the goods until the debt is fully clear. It means that, for example, I have promised to the bailee that I will give you 2000 rupees for the security of the car. Okay, means you just keep that car, okay, for 1 month, and I will give you 2000 rupees for the parking. Now, I have to give rupees 2000 rupees to the garage. Okay. So if I haven't give that rupees 2000, in this case, the garage can retain the possession of that goods until I return that 2000 rupees to that garage. This is known as bailee lien. Okay. Done. Now, there are different type of charges. First of all, there is assignment. Assignment means providing security to a banker for any advance. Okay, so if I am giving any security or collateral to the banker for any advance, that is called as assignment. Okay. Lien. Lien means bank has all the right to retain the possession of the good until the debt of the debtor is fully paid. And lien is an implied pledge. It means that it is understood from the circumstances. There is no need to give it in the written or to express it expressively. Okay. Set off, you know that the bank has the right to set off the debit balance of one account with the credit balance of another account, right? Hypothecation and pledge. Hypothecation and pledge, they both are related to movable properties. The difference is, in hypothecation, you don't have to transfer the possession of the goods to the bank. Whereas in pledge, you have to transfer the possession of the goods to the bank. And the one person who is delivering possession of the goods to the bank are called as the pawner, and the one who is receiving the goods as the security is called as the pawnee. Like, for example, I have given my stock of material which I have manufactured as a collateral to the bank for securing any loan. It means that I have pledged my stock of goods to the bank. Now, in this case, first of all, I have to transfer the possession to the bank. Because I am transferring the possession to the bank, I am called as the pawner, and the bank is called as the pawnee. Okay. Pledge, it is related to movable property. But in this case, you don't have to transfer the possession to the creditor. Okay. Next, pledge and lien. What is the difference between pledge and lien? Understand this. Pledge means the bank has the right to sell in case I default on payment. I have pledged certain goods to bank. It means that if I default on payment, bank has the right to sell that particular goods on the defaulting of the loan and recover the money. But in lien, if I have given any product and bank is leaning that product, it means that bank has only the right to retain the possession of that goods. Bank has no right to sell in the case of lien, but in the case of pledge, bank has right to sell that product. Okay. Next, hypothecation and pledge. What is the difference? Hypothecation, you don't have to transfer the possession of the goods. Pledge, you have to transfer the possession of the good. In case of default in hypothecation, first bank has to take the possession and then sell it into the market. Pledge, after giving a particular notice to the debtor, bank has all the right to sell that product in the market. That is the difference between hypothecation and pledge. And the thing is mortgage. Mortgage means when I have given any immovable property as a collateral to the bank for securing loan, then it is called as mortgage. For example, I have given my house as a collateral to the bank for securing any loan, so it is called as the mortgage, and the one person who is transferring is called as the mortgager, and the one who is receiving is called as the mortgagee. So bank is called as the mortgagee and I am called as the mortgager. Okay, so this is known as the mortgage. Clear? Now, if you have any doubt in this whole, kindly ask. Now, here there are different types of mortgage. Okay, now different type of mortgage is very important. Okay, detailed discussion is in the recorded video. You have to see that recorded video. Okay, any doubt here? Any doubt here? Yes or no, guys? Just tell me if you have any doubt. Any doubt? No doubt. Only Shirish has no doubt. Everyone else has doubt. If you have any doubt, please ask everyone. Okay, now let's move to the next thing that is known as non-performing asset. First of all, what is a non-performing asset? Non-performing asset means when there is any asset of the bank which ceases to generate income to the bank. That is known as non-performing asset. Acha, what is asset to the bank? Asset to the bank is like a loan. Loan is an asset to the bank and loan is generating income, and that's why it's called as an asset to the bank. Non-performing asset means when that loan ceases to generate income to the bank, then it is known as non-performing asset. Now, in which case a asset is said to be as non-performing? So first of all, if the interest or the principal amount is overdue for a period of more than 90 days from the date of repayment. So if you have repayment time period today, from today till 90 days, your payment is overdue and it is remains overdue for a period of more than 90 days, then it is called as non-performing asset. When your account is out of order status. Now, what is out of order status? Out of order status means when your bill remain outstanding for a period of more than 90 days, okay? Or when your outstanding balance in cash credit or overdraft is less than sanctioned limit, but you haven't credited any amount for 90 days. It means that, for example, I have a limit of rupees 1 lakh, okay, as a cash credit limit. I have withdraw only 50,000 rupees from that 1 lakh limit. Okay. But I haven't submit any credit money in the next 90 days. Okay. To cover up my outstanding balance. Then my account is considered to be out of order account. Or, or if I have withdraw more than my outstanding or more than my sanctioned limit, like my sanction limit is 1 lakh, but I have withdraw 1.5 lakh. Okay, now I have withdraw more than my sanction limit and it remains overdue for a period of more than 90 days. Then in all these conditions, my account is called as out of order status. Okay. So when I have out of order status, when my interest or repayment account or principal amount is not paid for a period of more than 90 days, when the installment or principal amount is overdue for two crop season for short duration crop. Short duration crop means where the time of the harvesting and cropping of that particular crop is less than 1 year. When there is a crop in which the harvesting plus sowing season is less than 1 year, then it is a short duration crop. And for short duration crop, you have missed two crop season. One crop season is equal to harvesting plus sowing. This is the one crop season. So you have missed these two crop season for a short duration crop and one crop season for a long duration crop. So if these four things are there, then your asset is called as a non-performing asset. Okay. Now, in non-performing asset, you will see the gross advances. Now, what is the formula of gross advances? Standard asset plus gross NPA. Then, what is the formula of gross NPA as a percentage of gross advances? Gross NPA divided by gross advances into 100%, right? What is the formula of net advances? Gross advances minus deduction. What is the formula of net NPA? Gross NPA minus deduction. And net NPA as a percentage of net advances, it means that net NPA divided by net advances into 100%. Important, expect a numerical question from this particular slide. Okay, next. NPA is divided into three categories. NPA is divided into three categories. NPA is when your amount is overdue for a period of more than 90 days from the date of repayment. Okay. Now NPA has substandard, doubtful and loss asset. Substandard means when it is overdue for more than 90 days but less than or equal to 12 months. Then it is substandard asset. Doubtful asset when it is overdue for a period of more than 12 months means 1 year. Then it is doubtful asset. And loss asset when the loss has been identified means bank has identified that there is something wrong happened, frauds happened, and now you are unable to repay to receive the money back, then it is known as loss asset. So till 90 days NPA, from 90 to 1 year it is substandard. Okay, from 1 year, more than 1 year, it is doubtful asset. And when the loss has been identified, then it is called as the loss asset, right? Provisioning norms. Provision means bank is keeping a certain percentage of its profit aside to cover up the loss from NPA. Every quarter, bank is keeping certain percentage of their profit aside to recover any loss from the NPA. That is called as provisioning. Now, provisioning is done in the case of lost asset, doubtful asset. You have to learn the percentage of these. Like, for example, in lost asset, you have to do 100% provisioning. In doubtful asset, you have to do the provisioning in case of unsecured, it is 100%. If it is secured, it range from 25% to 100%. From if, for example, your doubtful asset is actually more than 12 year, for the first year you have to do 25% provisioning. From 1 to 3rd year you have to do 40% provisioning. For more than 3 years you have to do 100% provisioning. So these are all the percentages you have to learn. Clearly I have just written every percentage here. Okay, provisioning norm, provision on the least asset. So these are the provisioning that you have to learn on every non-performing assets. Okay, percentage is written, you have to just learn the percentage. Okay, now let's talk about the acrylic. You know that acrylic is a what it is actually a centralized database which is created by Reserve Bank of India to receive information on the large borrower. Who are the large borrower? If your aggregate exposure is more than rupees 5 crore in all bank across India, right? That is known as acrylic. Okay, next, restructuring. Now what is restructuring? So restructuring is actually a process of giving some concession to the debtor. For example, if a debtor is in some difficult position, or from seeing the situation of the debtor, sometime bank or lender decides to give some concession to the debtor. Like for example, they just extend the repayment time period, they just decrease the asset. That process is called as restructuring, means giving concession, okay, to what, to the borrower because of the borrower's financial difficulty or something. That is called as the restructuring, right? Now, there is a new provisioning, okay, as per the new data in the substandard. For example, the earlier provisioning was 15%, now it is 15%, no change. From 6 months to 1 year, earlier provisioning was 15%, now it is 25%. Again, you have to learn all these percentages written. You have to just learn these percentage. Okay. So this is what? This is the non-performing assets. Okay. Now, if you have any doubt in this chapter, please ask everyone. Any doubt in this chapter? Now, let me see how much still left. Yes, this is, there is still a lot of to understand, and I think we have to continue it in the next class then, because now also I just am very tired now. Okay, so now we have a contract of indemnity now. Okay, so I think let's wind the session up today. Okay, again we have a class on Friday. Okay, I think I need 3 hours more. Okay, a 2 hour marathon session, then a 1 hour more marathon session for completing this complete module B. Okay, why? Because this is a very lengthy module. Okay, so maybe on Friday I am scheduling 2 more classes for you all. Okay, to complete this module D from contract of indemnity. We are continuing in the next marathon. Okay, everyone. So, did you all have understood whatever I have taught you in today's session? Yes or no? Did you all understood whatever I have taught you in today's session? Yes or no? So thank you so much everyone for joining this session. Please, everyone. So in the last class, you haven't rated the session, okay? So everyone, Shirish, Anju, Hema, Smriti, Gopal, Mohan, everyone who is watching this session, it's a request, guys, that please, before going, kindly rate out the session and give your feedback. It is very important to just please rate out this session and give your feedback, everyone. Okay, so thank you so much, everyone. Thank you, guys. Take care, everyone. Thank you. Bye bye. Take care. Thank you, guys. Take care. Bye, everyone.